Howdy, Jacob here. Today we're looking at next company in our dividend yield screener, ticker symbol VOD. 11% dividend yield, massive yield. These two metrics make it look like a screaming deal, but we know that calculating the intrinsic value of a company is based on present value of earnings and free cash flow. So we'll see whether their earnings are actually currently inflated or not. We see that market cap is $23.8 billion. That enterprise value doesn't look quite right. We see $44 billion long term debt with $7.3 billion in short term debt, 11 billion capital leases, 12 billion cash on hand. So a little bit of quite a bit of cash on hand, but in relation to their debt, there's still quite a bit outstanding. We see about 51.5 billion in debt outstanding and just 12 billion cash on hand. Let's see, on a 5-year average basis, a lot of cash flow here, a lot of free cash flow. Depreciation is absolutely massive, well over making up for the capital expenditures of the business. 5-year average basis is probably 13 million. Their dividend payout of 2.6 looks very reasonable. Their use of free cash flow in the most recent history is really all over the place. They're buying a lot of intangibles, um, selling off a lot of investments, actually, buying back a lot of shares, paying down a lot of debt, paying out a dividend. A lot of uses of free cash flow here, but it is good to see that their free cash flow is a lot higher than their earnings. That's positive for them. Have they made any acquisitions? So huge acquisition in 2020, and then huge devastation in 2023 of $7.4 billion. Revenue is still down quite a bit from 2014. We saw 64.2 billion in 2014, down to 48.9 billion in 2023. And there was a huge devastation in 2014, and really just two larger acquisitions. Otherwise, they've just been selling off parts of their business to increase cash flow and stuff. This is interesting. 6.3% operating margin in 2014 up to 31%. And then gross margin increase makes a lot more sense, just 5% increase, but still good to see those margins increasing. Dividend is down quite a bit from 10 years ago, but crazy that's still 11%. Okay. Let's start making some assumptions on this one. I feel like it might be interesting. So, revenue side, we'll say that it goes down maybe 2% a year. And then at the end of 7 years, there's even less growth, or there's more detriments to their growth after 7 years than now. So, saying a 7P is deserving. And then this is crazy. Their margins are so much higher on free cash flow. Let's see what a 2% bump to their debt would do. So about $50 billion is about 1 billion hit to net interest, and that's not even 10%. So that's great to see. I mean, I'm going to assume the earnings get a little bit closer. So let's say 10%, maybe even 15%, and then 20 on the free cash flow side. Buy back a little bit of shares. Let's say buy back 1% of shares. I mean, they can afford the dividend, but they're just using cash flow like crazy. I'm gonna have to do more research into the stock, and the stock price is even telling me I'm gonna have to do more research. So, 24% above getting a 15% return given these assumptions. I'm definitely gonna be doing more research on this. It's interesting because right now it looks like a screaming deal, but we're gonna have to figure out why that is. They do have a lot of debt on hand, so keep that in mind. But initial results are looking good. So just gonna have to do more research. And till then, hope everyone has a great day. Thank you.